Welcome to the Options Income Blueprint Weekly Income Report. This is Michael Schulman on October 3rd, 2022. A reminder, we have a trading session live tomorrow at 11 a.m. Eastern. I'm going to review, as I do every week, our trades and results from the previous week. And I want to talk a little bit, want to pull back a little bit from the here and the now in the market itself and talk about how do you beat a bear market with very, very simple but very, very powerful basics. Last week, we closed two winners. It was a conservative week, which I'll go over in terms of putting on new trades. But we did end up generating a significant amount of cash. But in the kind of market conditions, as you can see with these trades, you want to get in and out. You're going in, you're grabbing the money, and you're leaving when the market says, okay, you've had your profit, time to take it off the table and not put it at risk. In addition to that, of course, we are rolling our core positions in a couple of position that we've had open that's not core, which is Schwab, that we could be out of quite soon. We're in very good shape on the position now, and I'm going to talk about it at length in a few moments about the importance of rolling in a bear market, the importance of going week after week with a fundamentally sound company and using it to generate cash while the market is headed in the wrong direction. So overall, our annualized rate of return last year, these are cash rates of return. We're not talking about principal. We're talking about the cash coming in was very, 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 very high, with the goal being 0.26. It was a good week. Everybody else, or not everybody else, but most everybody else, was having a tough time between the volatility, the negative direction of the market, the closing out of the quarter, of the month, and so forth and so on. And actually, it's a calendar quarter. Many on Wall Street, probably still the majority of professional funds, especially in the mutual fund industry, their closing dates actually for where they're measured, get bonuses, etc., is often October 31st. But as you can see, the roll trades continue to generate significant amounts of cash, and we've staggered the way we roll many of our positions, so we have this constant cash flow coming in every week, which is, I assume, one of the reasons you're here. So last week, we did remain cautious, and it was a good thing. We avoided the worst of the sharp sell-offs. We played a game with the market going, we love this company. We think it's undervalued. We're going to trade it, and as soon as we have a reasonable profit, we hit our annualized rate of return goals, we're out. So the market may have been presenting a dark and threatening front to many people. For us, the volatility that the market created gave us a significant opportunity to get in and out quickly. So when you're in a bear market, the market itself has to dictate not necessarily the companies. In fact, it shouldn't dictate the companies. It does dictate some of the stocks, but more importantly, it dictates your tactics. So short term, you really can't time the market. If you could, you wouldn't be here. You'd be on a desert island that you own. But you can do the fundamental analysis of a company, and you can take a look at its competitors and how it's doing, and whether the stock by historical and current market metrics is undervalued. And you can trade that as long as you're willing to focus on cash rates of return and you're willing to think long term. So to use these tactics, your first step is, what do you want to do? What are your cash and income goals? And what is your tolerance for declining stock values while you're generating large cash returns like we did this week? Okay. And our cash return last week was 1%, which is why we have that range in there. And you can also, in addition to doing the fundamentals of a company and its stock, you can look at short-term trading ranges. You can look at where short-term bottoms are, short-term being anywhere 3 to 20 days. And this is something you're capable of doing. So you have to segregate out, what is my goal for my short-term trading? What is my goal for the long term? I mean, anything is going to be really wrong with Apple 3 years from now? Of course not. So you segregate, you parse, you shift your monies around. And that's why we have core stocks, Marvel, Pfizer, Citigroup, and General Motors, which have all been hit with the market, but they're fabulous companies, and they're the companies that throw off huge stocks, that throw off huge amounts of cash every week. So in short-term trading, let's take a look at what we've done lately. We've traded the Trade Desk, Roku, Devon Energy, Block, and Lennar. And you'll notice they cut across sectors. They're not in the same sector. We're not doing a sector trade. We have potential returns if our puts expire worthless of over 1% a week. And you look at these and you're going, why do you want them to be short term? Well, Trade Desk and Roku are highly overvalued based on traditional market metrics. Roku is about at fair value compared to its historical metrics. Trade Desk is undervalued compared to its traditional metrics for that stock, but they're still overvalued compared to the rest of the market. Devon Energy is subject to the whims of Vladimir Putin, MBS in Saudi Arabia, and so forth and so on. Block, which used to be called Square, will trade up and down, not violently, but very, very wide trading range, because it's often included in financial sector trades. It's a payment processing company. So when things go on with the Fed or with bank earnings, it can really move. And Lennar, one of the trades we made last week, many people have their funds are algorithmically aligned. So if interest rates go up, the builders of new homes go down, which of course was a mistake. We traded Lennar right after an interest rate announcement, and it's good to trade companies like that when they're in your bullpen. You follow them, you know their mechanics, you know their fundamentals, and the market's making a very short-term mistake. Now, long-term, we have the four core stocks that I alluded to. General Motors will probably overtake Tesla in terms of EV production by the end of the fourth quarter of next year. It's a much larger company than Tesla. It's like there's no comparison. And it's radically undervalued. It was trading near the price that the market paid for its shares when it came out of bankruptcy 12 years or 13 years ago. The government bought its shares for a nanosecond to get it out of bankruptcy. It owned part of the company and then sold them back in the marketplace. It's incredibly undervalued. Marvell Technology is a big, broad, diversified chip and component manufacturer. Again, its exposure to decreased demand is not meaningful. Last couple of earnings announcements, they've up forecast. And they are significantly exposed to the electric vehicle market, which is a net positive. Pfizer, the market still keeps on thinking COVID's going away. And I know I say that and people laugh. They can't be that silly on Wall Street. $50 billion company became a $100 billion company in 18 months. And what they're doing is taking that money and buying other companies. They bought, in a larger way, three, but they bought more than three, but three meaningful ones with accretive products that are ready to go to market or already in the market and accretive revenues. And Citigroup has significantly less exposure to personal credit markets and home refinancing markets than other banks, and it got hit harder than the other banks because of exposure to Europe and to what's going on with Ukraine. So at the core, you can analyze these and say, I'm going to just throw off my 1% in cash every week. So let's break down a short-term trade, Lennar. The market went south and it didn't like the home builders. We said, perfect opportunity. Stock had bottomed after a few hours, not even a few days. So we sold the 49 put, picked up $30 a contract. It was almost 10% out of the money. And that's what you do in these markets, in addition to looking at the charts. We closed it out just a day later. It's increasingly that we do this, but it's not the preferred way of doing things. And we booked a $17 per contract profit. Now, that doesn't sound like a lot, but it's 44% on an annualized basis. That is how Wall Street measures itself, and that's how we measure ourselves. All trades are measured based on annualized rates of cash, rates of return. And a short-term trade was Block. It was a little longer. We put it on via alert on a Friday, and it was 11% out of the money. 11. I call them silly puts when it's a short-term trade and it's 10% or more out of the money. So we closed it with a 37% annualized return. The target minimum is 32 for annualized returns in this service, And that is what you have to live by and be disciplined and line up with your personal goals. That kind of return, that's up to you to choose. But that's what we do here. Now, longer term, with Pfizer, again, ridiculously undervalued. It could be, you could get into an argument and say it's the most undervalued stock in the S&P 500. And we rolled, we have a 1.9% cash rate of return on the amount of capital that we have put in there. And so even though we're down from the original amount of capital we put, you can see where the cost basis is, we're committed to it for the long term, for another year, for another 6 months, for another 18 months, maybe another 2 years. And given its fundamental valuation and its explosive growth, the growth is tapering off, but the cash flow ain't. They'll be buying more companies and they'll be adding more products. And the last one is really, really important for those of you who go as rolling worth it. We entered the trade around the end of April 19th, I think, and the market turned against us. The market is down almost 20% since April 19th. We sold, the stock was over 77 when we sold a $75 put. We got stuck, quote unquote, in the position. It hit a new low at 59. If we had closed, oh my God, I can't take this anymore, let's get out, we would have suffered a 17.5% loss. We didn't. We stuck to it because it's a really good company. And as interest rates go up, the amount that they charge for margin, they also lend overnight to institutions, goes up. And that is their business model, as it is with all large asset accumulators. It's no longer what they make on commissions, it's what they get from lending against their assets that you have given them to hold. So this week we rolled it. We generated over $1. And if that expires worthless, we have a profit after being potentially down 17.5% and with the market down 20. So it may not be satisfying to say I didn't make any money on the trade. We made just a few cents. But on the other hand, it's a great company and a great stock. It just so happened the market turned against us, and now we're breaking even or making a little profit. And that is really, really important tool to protect your capital. Now, trading this week, expect more of the same. Expect perhaps only one trade during the trading session, maybe two, and then maybe one on Thursday or Friday. It really depends upon where our bullpen stocks are going and where the market's at. And as we roll and continue to roll, the cash just keeps on coming in. Now, the market's broken through support at 36.50, which is why I wanted to lead and discuss today tactics in a bear market, because it was, to my mind, an important support price for the market. There are no known big-time catalysts like a Fed meeting anywhere in the next couple of weeks. And the wild card, of course, is what's going on in Russia and Ukraine, as it has been for a while. Last point, in a couple of weeks, we hit the road, go to Las Vegas. It's a lot of, you can go, we also do offer it online, obviously. We have coaching sessions, live trading, one-on-one office hours are available one-on-one. Sit down and chat, talk about things. I'm not a registered advisor, I won't design your portfolio, but I'll answer most of your questions. And it's interesting, it evolves every year. Between that and what we call Investor Blueprint Live in Florida, we listen to you, and I and the other analysts, we evolve what we're trading, what we're discussing. We're going to talk about the structure and management of portfolios. We're going to talk about what we call one-day trading, which is not day trading. It's a way to structure periods of time to avoid downturns in the market or sit them out. And again, it's fresh material. It was all fresh material last year, and there's a lot of fresh material this year. So I hope you can find the time to either join us virtually or come and visit in Las Vegas. This is Michael Schulman. Thanks for listening.